Hello and welcome. In this video, we will learn what a future contract is. Alright? Now, let me take an example. The date is February 1st, 2023. Okay? So, just a random date. And let us assume that this is you. Okay? So, this person is you. And on February 1st, 2013, you are analyzing some stocks. Alright? And you have your eye on one of the stocks. And that stocks belongs to Infosys. Okay? So Infosys is an IT company. Alright? Infosys. So you have your eyes on Infosys stocks. Currently, let us say that Infosys is trading at rupees 2 per share or stock. That means if you want to buy one stock or share of Infosys, you need to pay 2 rupees. Alright? Now, this 2 is just a small random number that I have taken to simplify everything. Alright. Currently, Infosys stocks are being traded at 1400 rupees. So, this is just to keep the math simple. Alright. Now, let us say that this is the price at which Infosys is being currently traded. And according to your analysis, you believe that the price of Infosys stock will go up or move up. Okay. So the price of the stocks keep on moving up and down. Correct. So according to your analysis, you believe that the stock price will move up. Of which one? Of Infosys. Now, you have two options. One is to buy the stock itself. Alright. One is to buy the stock itself and wait till it goes up and then sell it. But then that is normally done by an investor. What does an investor do? He buys the stocks and waits for years so that the value of the stocks increases. But you are not an investor, you are a trader. Okay, you are a trader and you are in for a short time. So you do not buy the stocks. What you buy is a derivative. So this is asset, the stock, and derived from the asset is derivative. Alright. Now what is this derivative? This is nothing but a bundle of Infosys stocks. Okay. So this is a bundle of Infosys stocks. And this bundle contains 1000 stocks of Infosys. Okay. So it is a bundle of 1000 stocks. Do not worry about this number. We will see how this is decided later. Alright. Now, this is derivative and you believe and not believe, you are interested in buying this. Okay. This is real without expiry. That means if you buy a stock, you can keep it for years and years. Whereas this is imaginary. Alright. The bundle is imaginary, or you can assume this to be a basket or a bucket full of Infosys stocks. This is just imaginary, conceptual, and with an expiry. That means the bundle disappears after the expiry. The basket of Infosys stocks disappears after the expiry. Okay. And when is the expiry? Let us assume the date to be February 23rd, 2023. Okay. You decide to buy on February 1st. The expiry of the derivative is on February 23rd. Okay. Now, the current market price is 2 rupees of the stocks, and 2 into 1000 is 2000 rupees. This is what you have to pay to buy a bundle of Infosys stocks. Okay. Now, the price of this is not like this. It also has some calculation which we will see later. Alright, I am keeping this simple now. Now, this is what you have to pay to buy one stock. This is what you have to buy one bundle of derivative. Now, since this is a derivative of this, the price of this depends on this. Meaning, if the price of the Infosys stocks increases, okay, then the price of the bundle of Infosys stocks also increase. Meaning, if the price of this increases, the price of this increases. Whereas, if the market price of Infosys decreases, then the price of one lot or one bundle of Infosys stocks also decreases. Okay? Now, you are a buyer. Okay? You are a buyer. Why are you a buyer? Because you think price of the stock will go up in the future. Alright? So the buyer thinks the price of the stock will go up in the future. So what do you say? You say, I am willing to buy one lot of Infosys at 2000 rupees. Okay? Now what is lot? Lot is nothing but a bundle or a bucket or a basket of stocks. Okay? We use the term lot in here. So you say, I am willing to buy one lot of Infosys at 2000 rupees. You are a buyer. Now, in every trade, there has to be a buyer and a seller. So if you want to buy one lot of Infosys, then there has to be someone who is willing to sell one lot of Infosys. Correct? So there has to be a seller. So seller thinks the price of stock will go down in the future. Okay? So seller thinks this. You think it will go up, whereas the seller will think it will go down. Now who is a seller? Seller is a person just like you and me. Okay? Seller is a person just like you and me. So let us say that the seller is me. I am the seller. Okay? So according to my analysis, I believe that the price of the stock will go down in the future. So I say that I am willing to sell one lot of Infosys at rupees 2000. Okay? So you are willing to buy, I am willing to sell. And so you and I enter into a future contract. Okay? So a contract is made between you and me. You are a buyer, I am a seller. Now what is this contract? It is just a promise. It is just a word. Alright? Nothing is exchanged now. Nothing is exchanged physically. It is just a promise. This promise or word or future contract expires on 23rd February 2023. Okay? So this promise or contract expires on this date. Alright? Now, the date is 23rd February 2023, the expiry date. One of the three things can happen. First is, the market price of Infosys remains unchanged at rupees 2. It was 2 rupees per stock on February 1st. Till February 23rd, price has moved up and down, and on February 23rd, it has come to 2 rupees itself. Okay? It has come to 2 rupees itself. It has remained unchanged. So, the price of one bundle of Infosys stocks remains 2000 rupees. Okay? One lot of Infosys stocks still cost 2000 rupees. When this happens, no one gains. Neither the buyer gains nor the seller gains. Okay? So this is one. Next is the market price of Infosys increases to 3 rupees. On February 1st, it was 2 rupees. It has increased to 3, and on February 23rd, it is being traded at rupees 3. So, the price of one lot of Infosys stocks becomes rupees 3000. It was 2000 rupees on February 1st. Since this has increased and there is a direct link between the asset and derivative, the price of one bundle has increased to 3000 rupees. This means the buyer gains 1000 rupees and the seller loses 1000 rupees. Now, how is this? We will see in few minutes. Okay. Next, the market price. So, this is the third condition. The market price of Infosys decreases to 1 rupees. It was 2 rupees on February 1st, but it has decreased to rupees 1 on February 23rd. So, on February 23rd, this is the price at which the stocks of Infosys are being traded. So, the price of one lot or one bundle of Infosys stocks becomes rupees 1000. And so, the seller gains 1000 rupees and the buyer loses 1000 rupees. Okay. How is this? We'll see in few minutes. So, one of these three conditions can happen on the date of expiry, and according to these conditions, either buyer gains or seller gains or no one gains. Alright. Now, let us look at this and this. Okay, because this generally does not happen. It happens very rarely. Okay, very rarely. So, we will leave out this. We will see how this and this happens. Okay. So, we will take this condition first. The market price of Infosys increases to 3 rupees. So, the price of one lot of Infosys stocks becomes rupees 3000. Okay. So, this is buyer, which is you. This is seller, which is me. Alright. Now, buyer bought one lot of Infosys stocks at rupees 2000 on February 1st. Correct? You bought one lot of Infosys stocks at rupees 2000 on February 1st. Seller sold one lot of Infosys stocks at rupees 2000 on February 1st. So, you bought, I sold. Let us say that I sold it to you or you bought it from me. Okay. Now, if he had not bought, he meaning buyer, if buyer, you, if you had not bought on 1st February for rupees 2000, then you should have been paying rupees 3000 to buy the same lot on 23rd February. Correct? The price has increased to 3. If you had not bought on February 1st for 2000, then you should have been paying 3000 rupees to buy the same lot on 23rd February. So, you gain 1000 rupees, correct? By buying on February 1st, you have saved 1000 rupees. That is what the meaning is here. Correct? Now, if the seller, which is me, if I had not sold on 1st February for 2000 rupees, then I could have sold the same lot at rupees 3000 on 23rd February. Correct? So, the price has increased to 3. So, if I had not sold at 2000 on February 1st, I could have sold it on February 23rd for rupees 3000, which I did not do. So, I lost 1000 rupees. Okay. So, this is the first condition. This is how buyer gained 1000, seller lost 1000. Okay. Now, let us look at second condition. The market price of Infosys decreases to 1 rupees. So, the price of one lot of Infosys stocks become rupees 1000. This is the condition now. Okay. So buyer, which is you bought one lot of Infosys stocks at rupees 2000 on February 1st. And the seller, which is me, I sold one lot of Infosys stocks at 2000 on February 1st. Let us say that I sold it to you or you bought it from me. Okay. Now, if he had not bought, he meaning buyer, you, if you had not bought on 1st February for 2000 rupees, then you could have bought the same lot at rupees 1000 on 23rd February. Why? Because the price has decreased. Now it is available at 1000 rupees. So if you had not bought on 2000 rupees, you could have bought at 1000 rupees on 23rd February. So basically, you lost rupees 1000 by buying it on 1st February. Okay? Whereas, if he had not sold, he meaning seller or me, if I had not sold on 1st February for 2000 rupees, then I should have been selling the same lot at 1000 rupees on 23rd February. So basically, I have gained 1000 rupees by selling the lot to you on February 1st. Okay? So this is how you lost 1000 and I gained 1000. Alright? So this is the second condition. And what has happened between you and me is a futures contract. Okay? A future contract. Alright? Yes. So this is basically how a future contract works. Okay? Which is similar to a forward contract which we had seen in the previous video. But future contract is traded on exchanges. That means you can buy it using any stock brokers. Whereas a forward contract is not traded on exchanges. Alright. So let us forget about forward contract. It is of no use to learn here. So this is enough for now. In the next video, we will learn about a future contract in detail and learn how to trade them. Alright? Yes. So I'll see you in the next video. Till then, take care and thank you for watching.